Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, joined as always by Lana Chen, and today we are walking into Honeywell International, ticker HON, right in the middle of the most important story this 120-year-old company has ever been part of. They are breaking themselves apart on purpose.
On purpose and on a clock. The company announced in February 2025 that it was splitting into three separate publicly traded businesses. One advanced materials spinoff is already done. The final separation of aerospace and automation is targeted for the back half of 2026. So every quarter between now and then is basically a progress report.
And the market hasn't picked a side. Shares are at $236, market cap around $150 billion, and the stock is essentially flat year to date. We'll dig into why that flatness is more interesting than it looks. Honeywell is a diversified industrial conglomerate headquartered in Charlotte, North Carolina. 102,000 employees worldwide, founded back in 1906. They've been a fixture of American manufacturing for basically the entire 20th century.
Right now, the company reports in four segments. Aerospace is the largest: engines, avionics, flight controls, aircraft wheels and brakes, and a huge aftermarket parts and service business. Building Technologies covers fire, security, and building management systems. Performance Materials and Technologies does specialty chemicals, refrigerants, and industrial automation. And Safety and Productivity Solutions is the personal protective equipment and warehouse automation arm.
Those four segments get reorganized in the breakup. Aerospace becomes one company. Building Tech plus Performance Materials Automation gets bundled into the new Automation Pure Play, and the Advanced Materials piece already separated as Solstice Advanced Materials, which started trading in late 2025.
The simple way to think about it, they were trying to be three different businesses under one ticker. The market was applying a discount for that complexity. Now, each piece is going to be repriced on its own merits.
Revenue on a trailing 12-month basis comes in around $40 billion, roughly 40% of which is aerospace, making that the anchor of the whole breakup narrative. The architect of this transformation is Vimal Kapur. He became CEO in June 2023, which makes this about a 3-year run so far.
Kapur is a Honeywell lifer, and then some. He joined in 1989 as a graduate engineer in Honeywell's India operations, and he spent more than 3 decades working his way up through manufacturing, general management, and eventually running Performance Materials and Technologies.
What's interesting about him is he's the first Honeywell CEO to have come up entirely through the Indian business, which gives him a very different operating background than the more finance-trained CEOs who ran the place for most of the last couple of decades.
His reputation on Wall Street is operationally focused and data-driven, less of a public showman than Darius Adamczyk, who ran the company before him. Kapur took over, spent about 18 months doing a portfolio review with activist Elliott, pushing from the outside, and then pulled the trigger on the three-way split.
In other words, he didn't come in to defend the conglomerate. He came in to figure out whether it still made sense, and he concluded it didn't. All right, Lana, let's walk through the numbers. Start with valuation.
On a trailing basis, Honeywell trades at about 29 times earnings, roughly 3.7 times sales, and just under 10 times book value. Enterprise value to EBITDA is around 17. Forward price to earnings based on 2026 analyst consensus is closer to 22.5. That is not a bargain bucket multiple. That is a company priced like a high-quality industrial with a growth story attached.
And the growth story is mostly the breakup.
Mostly. On revenue, trailing 12 months comes in near $40 billion. The quarterly pattern is revealing. First quarter 2025 was $9.8 billion, second quarter $10.4, third quarter $10.4, and then fourth quarter dropped back to $9.8 billion. So the year ended softer than it started.
And that fourth quarter had the restructuring noise in it, right?
Right? Reported net income in Q4 was only $295 million, EPS of 46 cents, versus more normalized prints of around $1.5 to $1.8 billion earlier in the year. That was restructuring and impairment charges tied to the breakup. So the gap between GAAP net income and the operational picture was unusually wide in that quarter.
What about margins underneath the noise?
Margins are the good part of this story. TTM gross margin is 37%, operating margin is 18.6%, and net margin is 12.7%. Those are solid industrial numbers, comparable to the best in class.
Cash flow.
Trailing operating cash flow is $6.4 billion, CapEx is roughly $1 billion, so free cash flow is $5.4 billion, which is a free cash flow yield of just over 4% on the market cap. That's a real number, and Q3 alone threw off $3.3 billion of operating cash flow, which tells you the underlying cash generation is intact, even when reported earnings wobble.
Balance sheet.
12 billion of cash, 33 billion of total debt, 74 billion of total assets, 15.4 billion of equity. Debt to equity sits at 2.14, current ratio 1.3, quick ratio 1.05. Net debt to EBITDA is 2.5 times.
So it's levered, but not alarming.
Levered by choice. Honeywell has been buying back billions of dollars of stock, funding some of it with debt, and the equity side of the ratio is partly depressed by that. For an investment-grade industrial with $5 billion of annual free cash flow, the capital structure is defensible. Health verdict: the balance sheet is fine.
Let's pivot to the analyst community.
Consensus on Honeywell has skewed constructive through the entire breakup announcement. Out of the 30 most recent grade changes, the split is running roughly 15 buy equivalent, 10 hold equivalent, and basically no sells. Price targets have drifted up through 2025 and currently cluster around the mid-240s to low 250s, which, on a $236 stock, is about 5% upside.
The recent actions.
In April 2026, Barclays reaffirmed overweight. Morgan Stanley held equal weight in March. Wolfe Research upgraded to outperform from peer perform in late February. Wells Fargo, Citigroup, and JP Morgan all maintained their ratings in late January after Q4 results. The tone from the sell side is essentially the breakup math works on paper, and we need clean Q1 2026 numbers to underwrite it.
So it's a show-me quarter coming.
That's the setup. The next earnings print is April 23rd. EPS consensus is $2.33 on revenue of about $9.3 billion. In the prior 4 reported quarters, Honeywell beat consensus EPS in each one, though revenue came in light in 2 of them, including the most recent Q4. So the pattern is earnings beats but revenue softness.
All right, I've got the bull case. Point 1, the sum of the parts thesis. 3 focused pure plays should trade at higher combined multiples than the conglomerate does. Aerospace standalone could get a re-rating toward peers like GE Aerospace, which trades closer to 35 times forward earnings. Automation gets a software-adjacent multiple. Advanced materials becomes a clean M&A target. Point 2, the aerospace aftermarket tailwind is real and durable. Global flight hours are back above pre-pandemic and continuing to climb. Honeywell's installed base on narrow-body engines and business jets generates high-margin parts and service revenue for decades after the initial sale. Point 3, the balance sheet has more room than the headline leverage suggests. $12.5 billion in cash, investment-grade rated, $5 billion in annual free cash flow. This company can fund the breakup and keep returning capital at the same time. Point 4, capital returns track record. Dividend has been raised 14 years running, yield around 1.9%, and buybacks in 2025 totaled roughly $4 billion. Shareholders are getting paid while they wait for the split to close. Point 5, the forward estimates. Consensus has revenue rising from $39.6 billion in 2026 to over $47 billion by 2029, and EPS growing from $10.50 to nearly $14 over the same stretch. That's a 10% annualized earnings growth trajectory. If Honeywell executes close to that, the current multiple looks reasonable in hindsight.
My turn, the bear case. Point 1, breakup execution risk is non-trivial. GE's split took years, cost billions in dyssynergies, and there were quarters in the middle where the narrative got ugly. The same playbook here means real risk of short-term margin compression and one-time charges in 2026. Point 2, Q4 2025 was an ugly quarter, and it happened right when management needs clean numbers. Revenue missed. Net income collapsed to $295 million. EPS of 46 cents was well below prior year quarters. If Q1 2026 shows the same pattern, the breakup story gets harder to underwrite. Point 3. The valuation is not defensive. At 29 times trailing earnings and nearly 4 times sales, Honeywell is priced as a growth industrial. Any macro slowdown, tariff escalation, or aerospace cycle turn hits the multiple before it hits earnings. Point 4. The buyback at a 9.7 times price-to-book ratio means Honeywell is paying roughly $10 for every dollar of book value retired. That's a high price for a reduction in share count, and it makes the balance sheet look stronger on per-share metrics while genuinely consuming capital. Point 5. Competition is not standing still. In aerospace, Collins and Raytheon compete head-on. In automation, Rockwell, Emerson, and Siemens have all been taking share in discrete control. In advanced materials, the list of specialty chemical rivals keeps growing. The breakup has to unlock enough focus and agility to fight 3 separate competitive battles at once.
Who do we compare Honeywell to?
For industrials of this size and profile, the cleanest peers are Eaton, Deere, and Caterpillar. Eaton, at around $400 a share, trades at a premium industrial multiple, price to sales around 5, strong margins. Deere is more of a pure-play ag and heavy equipment, trading around $618 with a richer multiple driven by its technology and services push. Caterpillar sits in construction and mining equipment, more cyclical, and generally trades at a lower multiple.
Where does Honeywell fit in that group on valuation?
Honeywell's PE of 29 and PS of 3.7 put it in the middle of the pack. More expensive than Caterpillar, less than Deere, roughly similar to Eaton on some metrics. Honeywell's operating margin of 18.6% is competitive, but not the best in the comp set.
And once the split happens, the comp set changes entirely.
Exactly. Post-split, Honeywell Aerospace gets benchmarked against GE Aerospace, RTX Collins, and HEICO. The automation pure play gets compared to Emerson, Rockwell, and Schneider Electric. So the current peer group is almost a historical artifact. What matters is where each piece lands after the separation.
Options market, Lana.
Heading into the April 23rd earnings print, 30-day implied volatility is running around 25%, which is elevated versus a typical 20 to 22% baseline for Honeywell. That tells you the options market is pricing in more movement than usual.
Flow direction?
Put-call ratio is running around 0.7, which is modestly call-heavy. Open interest is clustering at the $240 and $250 strikes for the May expiration, which is where traders are positioned for an upside move after earnings.
Expected move on the print.
The straddle implies roughly a 4 to 5% move in either direction on earnings day. For context, Honeywell has historically moved 3 to 6% post-earnings, so the options market is priced right in the middle of that historical band.
Insider trading picture.
Over the last 6 months, insider activity has been predominantly sells, which is typical for executives at a large-cap industrial exercising vested stock options. No unusually large open market insider buys have shown up. That kind of conviction purchase is uncommon in industrials this size.
What about corporate buybacks?
The bigger story is the company buying its own stock. Honeywell repurchased $1.9 billion in Q1 2025 and $1.7 billion Q2, then dialed it down to roughly $100 million per quarter in the back half as management preserved cash for the spinoff. That pattern tells you a lot about capital allocation priorities through the transformation.
Risks ranked.
First is the commercial aerospace cycle. Any airline capex pullback or Boeing production issue hits Honeywell Aerospace directly, and aerospace is the most valuable piece of the breakup. Second is breakup execution and timing. The final aerospace automation separation is targeted for the second half of 2026. Any slippage invites activist pressure and shareholder frustration. Third is China exposure. Roughly 12% of revenue runs through China, which is vulnerable to both macro weakness and tariff escalation between the U.S. and China. Fourth is refrigerant regulation. Advanced materials depends on the generational hydrofluoroolefin transition. Regulatory reversals or cheaper alternatives would be material to that segment. Fifth is acquisition integration. Honeywell has been active on M&A through the transformation, including the carrier security business. That deal needs to deliver the promised accretion, or it becomes a drag.
And the catalysts to balance those.
Q1 2026 earnings on April 23rd is the near-term one. Formal separation filings later in 2026. Any sell-side sum of the parts analysis updates as the split gets closer. And the annual Investor Day where Honeywell typically re-underwrites segment targets.
So what's the summary?
Honeywell, in April 2026, is a company mid-transformation, priced roughly at market multiples, with a clear catalyst path but real execution risk. Aerospace and automation have durable moats, the balance sheet is sound, and the breakup offers genuine optionality. The risk is that Q4 2025 showed the first cracks in operating momentum right when management needs clean numbers.
Single most important metric to watch?
Segment operating margin. If aerospace and automation both hold above 20% through the breakup, the sum of the parts thesis works and the stock gets re-rated. If margins compress meaningfully in either segment, the market will punish the stock well before the separation actually closes.
Clear framework. April 23rd earnings is going to be the first real test.
Final word from the CEO. Paraphrasing Vimal Kapur's comments after the February 2025 breakup announcement, breaking up the conglomerate doesn't mean admitting defeat. It means acknowledging that what made sense in 1906 doesn't necessarily make sense in 2026.
That's honest. It also puts a lot of weight on what comes next. And the next checkpoint is 10 days away. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
I'm Hudson Thomas.
I'm Lana Chen.
This has been Charged Alpha. We'll see you next episode.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.